I'm Caroline Plumb. I'm the Group CEO here at Gravita, and it is my great pleasure to welcome you to our new offices. This is the very first event we've held here, as you can see by our kind of switch over to the higher chairs at the last minute. I hope you enjoy the view and the evening we have in front of us. I'm delighted to welcome our wonderful panel here this evening. We're going to talk about transaction triumphs, a topic that's very close to my own heart, having both kind of raised funds myself as an entrepreneur through kind of angel rounds and seed rounds. I've kind of been on the sell side for my own businesses twice, but more recently on the buy side for Gravita over the last sort of five transactions. So I know something of the kind of highs and lows and ups and downs, and we thought we might touch on some of those this evening. So I'm going to be asking the panellists what they wish they'd known about transactions, some of the kind of top tips. Hopefully we're going to give us some kind of insider information that we don't normally hear, but we'll try and tease it out of them. So without further ado, I will introduce our fabulous panellists, and I'm going to be asking them to introduce themselves, plus a fun fact in a moment, so heads up. But we've got Oliver Tonkin, who is the CEO of BCB Group, a leading global provider of business accounts and trading services for the digital assets economy. David Gilmour, who is the Managing Director of Imperium Group, a fund services group based in Guernsey, Jersey and London. And our very own Tom Adcock, tax partner here at Gravita. So, first up, bit of an intro to yourselves, if you might. Perhaps picking out some of the kind of highs and lows of your transaction journey and, of course, your fun facts. Oliver.
Hi everyone. So yes, as you said, I'm Oliver Tonkin. I'm the CEO of BCB. We've been going for 7 years. I've been involved in raising about $60 million for that business in multiple funding rounds. So I've got some experience of VC rounds. Before that, I'm also a practicing corporate lawyer. So before that, I worked for a large global firm doing M&A in the UK and Europe. So I've got some M&A experience. I also ran a private investment fund for 10 years with some colleagues before that. So I've done M&A, I've done venture, I've done distressed investing, Fun fact, oh God. I got a hole in one the other day. I was like, oh, that's quite
Okay, hi, David Gilmour of Imperium. So I'm based in Guernsey and Channel Islands. We have an office in Guernsey, Jersey and London. Started off in private client. I was at Rothschild previously, and I moved across to Guernsey to run a private client business. We have a number of clients who are kind of tech entrepreneurs, so 30, 40 clients who have either set up structures pre-IPO, post-IPO, and we manage their affairs going forward. We've also got a fund administration business, as you pointed out, that's strong. We're running north of $3 billion of assets under management, and it's all private equity and venture capital funds. So again, much like Oliver, involved in deals before they happen, deals post, and managing assets and affairs after. So,
and fun fact.
Fun fact. My name is David Gilmour. So older people think a Pink Floyd relation. I get terrific restaurant tables in London, but very disappointed when I turn up.
And Tom.
So Tom Adcock, tax partner here at Gravita. I was once upon a time a tax inspector. Is that your fun fact? That is my fun fact. No, so no clapping at all. So what I do, I help people understand the UK tax environment. I work usually with people who are overseas, cross-border transactional work. So most of the work I do is international. The team itself does everything. I do everything as well. Most of the work I get involved in is that. When it comes down to transactional stuff, I've got 3 deals on my desk. We're doing a lot of M&A transactional work at the moment. Selling businesses, buying businesses, restructuring businesses, using EOTs to manage private client positions, and all the other fun stuff that you can do with transactions. I think from the stuff that I do usually is trying to make sure we get a smooth ride through the M&A process, to make sure the clients get what they're looking to get out of it, which is starting off from get the structure right, get the deal right, get your exit right, if you're on the sell side. Fun fact, to sort of stick maybe a little bit with the sports star and famous people thing, I once faced Darren Goff in the nets. I hit the first one, I didn't see the second. It was a bit miffed, but I hit the first one. So that's my fun fact on Sport Club.
Oh, nice, brilliant, thank you. Right, so first question. Lots of transactions. I'm sure some go brilliantly and some less so. So how do you maximise the value in a transaction, whether that's a fundraise or an exit? What would be the main sort of pieces for getting the best of the deal? And let's start, from a commercial perspective, from a legal perspective, and also from a tax perspective. Top tips.
Do you want me to go first?
Yeah.
No, you go
Yeah,
first.
go for it.
I think it's time to say. Go on.
Okay, so I've been involved in 7 transactions to the point where we're now 145, 150 people across the group, and you do start to see pitfalls in transactions and you see opportunities. It is all about tech. It's all about you're seeing a business that quite often is run poorly, corporate governance hasn't got a framework, and you're trying to improve the framework of the business. Very often that is tech related, trying to get to a standard where you can see you can start to marginalise the gains, and yeah, I mean, it gets easier and easier. You'll see potential pitfalls and just try to mitigate.
I think from my perspective, I've been involved in sort of M&A and deal doing for 25 years now, and I started my career very much kind of on the legal side. So in terms of the kind of whole journey of a deal, obviously the lawyers are very much involved in the bit before you sign it, or when you sign it complete, and then they sort of go, oh, lovely, great, job done. Here's my invoice. On to the next one. Well, I guess you. And I think my big learning from moving from that to actually sort of running businesses pre and post M&As, actually that's only the start of the journey. And you must not forget that once you bought something, you've actually got to run it, and you've actually got to integrate it, and you've got to make some, generate some value out of it. And it's very easy to forget when you're moving from the advisory side to the operation side. And I can give examples more recently when I had great success on that, and some where it's not gone quite so well post closing. So that's my big learning from kind of my career is don't forget you've got to run the thing after you've bought it.
That's really interesting. And if you went back in time as an advisor now, knowing what you know now as an operator, what would be the things you'd have sort of negotiated or thought about differently?
Well, there are some deals that I would probably tell people not to do.
Right. Okay.
But of course, that's not good if you're a lawyer because you want to do the deals. You're going to get paid. So there's always a bit of moral hazard there, I think. The best advisors will be brave enough to say you shouldn't really do this deal, but they're actually less common than
Totally agree.
than you think.
Right. Yeah.
Your clients end up wanting to do a deal, and they'll do the deal,
Right.
even if they don't see the actual pitfalls ahead of them. They'll still try and do the deal.
Because you think it gets into kind of a moment where everybody's just so focused on the transaction they forget about
absolutely.
the wider.
Yeah. See it time after time.
Right.
Yeah. And clients will pay for deals, always.
Okay.
You talking about?
Yeah, I think, and I agree with everything that's been said. Clients do get blinded by the fact that they've got halfway through a transaction and they just want to get it over the line.
And
I think that is definitely true. And they'll look past or look over or just ignore like pretty serious red flags just to get the deal done. And deals are more complicated now than they've ever been, right? The legal, the tax, the whatever gets in the way. I think from working with clients on M&A transactions, both sell and buy side, from a tax perspective, and just focusing on that for a second, because it's so complicated, because it's gone from 2 books to 6 over the past 20 years just in this country, many things can go wrong. Right? You're trying to run a business. Right? At the end of the day, that's what you're doing. All the little tax stuff, right? It sort of is what it is. If no one's pointing it out to you, you don't know it's gone wrong until someone like me looks at it on DD and goes, "What have you done that for?" And it's then sort of working through that process of saying, okay, there's been a mistake, there's been an issue, there's something we've got to deal with, and then approaching that properly. Because really it's probably only money at the end of the day, it's probably just cash, working out what the X factor is and then working with the client about how to resolve that issue. So that, from a tax perspective, that's the bit that you will see trouble, you try and sort of solve it as you go through. So.
Okay, but this is a good segue into, okay, so we're maximising value, but what about red flags? So, on any deal there tends to be green, amber, red. When people looked at the red, categorised it as an amber and kind of pressed on when they should have stopped. So what are the big red flags you see on deals?
Well, I'll tell you a story if you're interested, because I'm here, so you must be interested. So BCB, the business that I currently run, we agreed to buy a German private bank 2 years ago, in 2021. We did, yeah.
I do.
And we raised money to buy the bank, and we agreed the deal. Did the DD, which was, I would not say it was a perfect DD report. There were some things in there that were
Financial or legal DD or?
Very financial actually,
Right,
mainly
yeah.
around the kind of balance sheets, and there was a technical, there was a product that these guys were selling which was very profitable but very balance sheet hungry, and they'd done some work. Oh, it's all fixed now, it's all capped, and there's nothing to see here. So we did the deal, raised the money, did the deal, and it was a lot of work. Everyone was very happy. No one was very happy. They got paid. But fortunately or unfortunately, the change of control process for the BaFin, which is the German regulator, took a very long time. It took 18 months, and it just got to the point where they'd approved the deal. So it's like, what's next? During the period, this balance sheet thing, which they'd said they'd fixed, actually got quite a lot worse. To the point where, if we'd completed on the deal, we'd have had to have put in 20 million euros that we hadn't budgeted for, and we didn't have. So we had to. The choice been either you go ahead and do the deal and ask the investors for more money, that wasn't going to happen, or be very brave and say, guys, I'm terribly sorry, this wasn't what we thought, we're out. And that's what we did.
That went down really well.
It didn't get down that well. But this is the thing, it's a devil in deep sea. If we'd done the deal, we'd have been in a lot of trouble.
Yeah.
So we had to pull out. So that's the kind of thing where deals have momentum, but there's a limit to that momentum.
Yeah.
If it involves the insolvency of the buyer, kind of less attractive. So that's an example of something that comes a point where you, even with that momentum, regulatory momentum, everything else, we had to say, look, sorry, no, doesn't.
And do you think actually the difference between the kind of the emotion of the deal and having to wait for the regulator actually put enough cool heads onto it?
100%. Yeah, I mean, if BaFin had taken a month, we'd have probably done the deal.
Right.
And then we would have bought the problem that we only became apparent later.
So, and what do you think you can do then if you're doing a transaction and you don't have the regulator kind of give you 18 months to wait around?
Try and be dispassionate, but as you say, it's hard, right? There's a reason why people sign heads of terms that are non-binding, because it creates momentum.
Yeah.
Sign heads of terms that now I've got to do the deal, right? So
we do that.
That's why it's a mental thing, because you've almost mentally bought it, and you do sign heads of terms. It's like, well, now we just have to do the contract. So it's very hard. It's very hard, and you have to be dispassionate, and you have to get rid of FOMO as well, particularly when there's a top of the market type thing. Got to buy this thing. But be dispassionate. It's not as easy as you just saying it. It isn't that easy.
And private equities change the dynamic in pretty much every industry, particularly financial services.
Yeah.
So your industry, financial services, when we're operating law firms, investment managers, private equity is now a huge player in all of those sectors, and private equity are coming in and buying up and driving price up. Yeah. There is almost a smaller and smaller pool of businesses that are independent that are getting bought up by private equity, and there is a rush to buy these businesses. They're prepared to pay quite often many times multiple what they should be, and as a result, price is quite often a factor, but it's not as key a factor as it should be.
Turn to the sell side.
Yeah, definitely.
If the dollar sign is what sort of keeps people motivated sometimes, and they lose sight of all the other problems they might create for themselves or for their people that they work with, and that I think is quite a main driver in that. On buy side, looking at people trying to do the deal, I agree completely with what you're saying. Like, a number of times you sit back and cold like a day and you go, what are you doing? Like, this is not a particularly attractive thing to do. I got involved in a deal a few years ago now, big property transaction, and it's a VAT problem, and I'm not going to bore you with the details.
Please
but I mean, it's properly exciting stuff. But including penalties, it was 12 million quid. That was the problem. And that should have killed the deal. Should have killed the deal. But it didn't, because the buyer was just hell bent on. He was like, no, I need a solution, need a solution. And we found one. We did, because that's what we do. We find solutions for people, and we got them over the line. But they really should have stepped back at that point and said, no, actually, that is a lot of money. That's a lot of problem. We should step back. The seller actually had the same conversation. The seller was, because we were sort of involved in both sides of the transaction, and the seller had the same conversation. The seller was like, hang on, wait a minute, if I've got a £12 million bill, I've got to pay to the revenue. So maybe, yeah, you do. He's like, well, I need to sell the asset. I want this off my desk because I've got this problem and I don't want it anymore. So he was motivated to get rid of the asset at a much lower value because of this tax problem thrown around in the background. And that sort of momentum that you're talking about was just driving the whole transaction. And we did get it through in the end, but it should have killed the deal. It didn't. I was always surprised about it. It didn't stop it. So.
Financing's become a big issue in the last couple of years. Obviously, interest rate rises. Private equity are now finding more and more expensive to finance arrangements. So people have bought businesses 2 or 3 years ago that they thought would be quite cheap to finance, and now they've realised it's not. And it's causing issues. We are seeing clients that have bought businesses that now are underwater, just with the financing costs.
Just too much leverage.
Yeah.
And back to the kind of red flags, or anything that you've seen in the deals that you should have said, no, red flag, stop?
Look, I mean, it depends how much effort you put in to doing something, integrating something once you buy it. I think, as Oliver said before, it comes down to the culture of the business that you're buying, and can you assimilate it and integrate it as quick as you can. Providing that people are with you in that that kind of phase, the integration phase, then it's usually successful. But it's difficult. You really have to put the effort in once you buy a business.
So it's that kind of opposite almost of like Adam's, the kind of time kills deals, but you're saying actually maybe that's a good thing in many cases, that actually some of them should have gone in the...
I think it's all about communication as well. If you buy a business and you tell the purchased party or the seller what your plans are for that business, how quickly you're going to try and integrate things, but there's a clear plan for that integration, then that's that's kind of what they want to hear. Communication's key. And we've bought businesses before where communication's been so poor that the deal's almost fallen over. It's almost been a bad buy.
By the time of the sign.
No, but like a year into the integration, you've bought a business. There's not been any real clear plan. There's been no communication to the team that we bought, and as a result, they've ended up either leaving or the deal's fallen over. It's all about communication and clarity.
So we're thinking then about the kind of other types of transactions, perhaps also on the sell side. How do you become investor ready? Either investor ready or exit ready? What would be the kind of key things you'd be thinking about?
I mean, I've obviously more recently been involved in raising several rounds of venture capital. So it's not necessarily an M&A, but it's people are giving you money. So it's kind of the same thing. And I think
still selling equity.
Yeah, selling equity, exactly, yeah. So I think, obviously the market's changed quite a lot the last couple of years. To your point, cost of capital's gone up. So there isn't an unlimited wall of cash being kind of hosed at sectors or markets with no real regard to how you're going to make any money. Those days, I think, are probably gone for now. I mean, there's much more focus on, have you got a viable business? Can it be profitable? If it's not now, can you get it profitable? What's the things that... Again, those days of just never mind about the bottom line, top line's all that matters. Those days they're certainly not here right now. So there's a much greater focus. I noticed it because we're looking at Series B right now. So much greater focus on brilliant. You've got this far, amazing. But what's your plan for sustainable profitability? And for a lot of people, and certainly in kind of technology, kind of venture space, they find that a really hard adjustment to make because they've been so used to just raising money on.
That's in the IM.
It's a real rude shock, and I mean you've seen it. I mean a lot of businesses in the sort of fintech space have failed because they just were relying on the next round, and that next round hasn't come because they cannot show that they've got a sustainable, viable business model.
I'm on the board at Mercia, which is an analyst in asset management. So we sort of have about 2 billion funds under management across sort of early stage venture through to kind of debt funds, private equity funds. But I think definitely we've seen there that for good businesses, the valuations are holding up still, even at the early stage, even through probably to Series A, and then as you say, kind of Series B, it's starting to tip into this whole sort of rule of 40. Suddenly, that's where you have to whether your top line growth and your EBITDA have to add to 40 somehow. So you can be doing 60% growth and minus 20% on the bottom line, or you can do 80 and minus 40, or hopefully 20 and 20 as well, which people are sort of trying to aim at. But it does seem to be a real sort of inflection point in the market in terms of pricing now.
I mean, also, I remember 5 years ago, 4 or 5 years ago, everyone was trying to cut costs before a sale. You were trying to look attractive, trying to create that as big a margin as you could before a sale. This is for a more mature business.
Yeah.
And I think that's, I think it's a misnomer. I think it's a see-through.
It's completely obvious.
Yeah, it's so
on the
obvious.
buy side,
And especially our industries, you saw people trying to cut costs to try and get the best price they could, and some private equity houses didn't care. They saw the margin and went for it. Where I think you should go along as you have, BAU, try and create that kind of USP, that advantage, and try to keep your costs as they have been in the last few years, and people will see a quality business as opposed to trying cutting costs.
I think it's always really hard, when you're running a business and you're also then trying to sell the business or raise finance, you have to wear both hats at the same time. You've got to kind of run the business day to day. You've already had a day job doing that, and now you have this whole other job trying to raise money as well.
It is brutal.
Yeah.
I mean, from a time perspective, it is really hard. I'll never misunderstand when you're talking to the client, they've got a job to do. They're trying to run a business. We sold our business recently, and that is really hard. It takes a lot of time, a lot of energy, and a lot of effort from key people to come together to focus on it. And you shouldn't be doing it at the end of the day, because it's your business, and you should be focusing on that, not necessarily other stuff. But it's got the time. What I was going to say was about it's boring, but it's really important. It's structure. So often we're working with a client at the moment. It's quite an interesting story. They were Dad was quite good at finding water, weirdly. So he worked out clever ways of drilling for water. I know.
It's like rods.
Yeah, exactly. That's what I've got in my head. It's like dividing rods, right? And but the sons sort of picked that up, and instead of drilling for water, they drill for other stuff, unsurprisingly. And they've become quite good at that, and they're sought after all over the world. And of course, where you're looking for some of these things you get out of the ground that people value, you're in some interesting parts of the planet. So they have these entities everywhere. And they never thought about structure. They never thought, well, having an entity in Belize or in some parts of Africa or wherever is going to be a problem. And they also didn't care about who owned it. So one of them might own it, or some weird mix-up. And so they wanted to sell. And now you're looking at this organically grown structure which spans 13, 14 different countries around the world, all with different tax environments, all with different rules, all with different accounts, and most of them with different languages. Trying to bring that together into one place so it is in a wrapper so it can then be sold to a buyer is the challenge. So for their perspective, it's that work that needs to be done. Get the structure right so that it's not just attractive from all the other reasons, because they have to do that. As it happens, they're quite good at that bit. They don't need much help on making money, these guys. What they need help in is making sure that what they can sell is actually sellable.
And how long before a kind of an exit event or a fundraising event would you think about structure? How long would it take to reorganise something like that? It sounds like a big job.
That one particularly has already taken a year and a half.
Right.
Because you've got to get advisors from all over the planet to come together to do stuff. But I think if it's a normal business, like a sort of standard UK thing, I wish we'd done ours a little bit earlier. I think we should have sat back and spent probably the previous year looking at how our business was structured before we went through a transaction.
So 12 months before?
12 months I think would be about right. And I would do the red flag bit first, look at the problems you might have in your business, really understand it, structure it properly if it needs restructuring, and then going through the transaction. I think that would be quite sensible. That would be my sort of view of it, on a normal sort of UK transaction.
And obviously it depends on the size of the business, but advice has got to be sought. Depending on whether you're big enough to list or whether private equity is an option or a private sale, you've got to know what your target market is and how you can approach that. And advice is key. You've got to take advice on the way forward. If you say 12 months before, if you come out to sell, you're going to sell, get the structure right, get the advice right, get the tax right before you sell.
Yeah. Yeah, I mean, I wonder if it's partly also to do with really knowing your buyer or your investor, because I think understanding the fund dynamics that sit behind it is so important, isn't it? Because if the fund is, a $100 million fund, and it's a big VC fund, it's got to return 3 times on the fund, they run their own kind of Monte Carlo analysis inside, don't they, to kind of get the portfolio returns, and they only care about the portfolio returns. So you always want to know how far invested, how much more dry powder, what big exits so far, how long's the hold. And then because you're at VC, our VC investor Tenzing, it's from a £400 million fund, and so they have a kind of asset concentration limit. How much equity they deploy in any one asset. They'll probably do 10, 12 assets per fund, and just understanding their own internal rate of return, how far through invested they are, their own hold periods. I think it does go so much to the investor mindset and how they're feeling at the time of where their willingness to make the deal.
Yeah.
And there's a huge difference, of course, in the growth funds.
And where they're on the cycle as well, where they're on the PE cycle.
Yeah.
So if they're 4 or 5 years into it, then
Yeah.
different challenges.
Yeah.
And fun vintage as well.
Yeah. There's some brilliant vintages to I think the word is probably lucky darts. And that's very interesting. And what about just knowing it's like a trade sale then? So, thinking through knowing your buyer. Any top tips?
There you go.
I've done a few trade sales as a seller and a few as a buyer. And I think again it's all about cycle as well. If you're at the top of the cycle, it's an awful lot easier to find multiple buyers who'll kind of pay. You get a nice auction going. It's great. And then at the bottom of the cycle, you're almost sort of going, well, Christ, I'm not take anything. And it really is that.
Yeah.
That's it for all in a lot of cases.
Yeah, so having that optionality, that unless you have an alternative plan.
I think it depends on what the business wants to do after the sale.
Yeah.
So if they want to continue as they have been, or they want to just get a bit bigger, then they're going to want to try and get into being an investor or a purchaser who's got similar culture.
Yeah.
If it's totally different, then it's not going to work, or they're going to have to seriously think about integration.
No, I was going to say, succession is the thing. What are you trying to do with your business when you sell it? Are you selling it because you want to take some money off the table and stay in the game, keep running, or are you leaving? And to speak to the sort of bottom and top of the cycle piece, using things like EOTs to bounce your transaction through, so you get your sort of no tax outcome, which is great, lovely, wonderful, thought works. But you can trigger the transaction early, so you can start the process, and then when you start to climb back up that curve, then you can sell it, get the cash out, and you're in a much better position. So I think that's something we're working with clients at the moment, because nobody can work forever. I've worked with someone who tried, and
still working, isn't it?
no, I think he has finally down tools, right?
Okay.
And so I think people will take a decision from a life perspective when they're going to step out. And then they sell it, but selling at the bottom of the market isn't obviously right for them. So using those types of devices to do it is quite helpful. So yeah.
But I think you make a really interesting point about the sort of people and the dynamics in it, because I think when you're running a business, you have a business management team, everyone's your investors, everyone's really well aligned, and then at the point of a sale, I think that's where you get this misalignment. Either it's because like the waterfall and the proceeds are going different places. But also, I found sort of as a founder here, originally, you kind of got this 3-hat problem. So you're a founder or an employee, you're a director of the business, so you're a fiduciary duty to do the right thing, and you're probably a shareholder in the business as well. So you've kind of got 3 very different perspectives on the transaction that may not be aligned at all, and actually be a very lonely place because maybe others have only got one of those perspectives. So can you talk a little bit about perhaps the emotional curve, read the journey, or some of the challenges that kind of come at the point of the sale, and what you can do to safeguard yourself?
Well, don't also get, a lot of people that sell a company to somebody else don't get all the money right away. There's often deferred consideration and everything else, and you've got to stick around for 2 years and carry on. So there's that. If you've got your PE back, the PE money's gone. But maybe as a founder and an employee, you've got to wait. You've still got to carry on for 2 years before you get your money. So that's what you were saying. I mean, interests are not aligned in that case, are they? So I mean, you've got to carry on. But I mean, an emotional journey. I mean, as I say, as an advisor, if the deal's done when it's done, and you walk away. As an owner or as a principal, particularly if you're still involved in the business. It's a slightly different feeling, I think. I mean,
it's a lot less emotional on the buy side than the sell side.
You are selling the thing. A lot of the time you've
built.
Exactly. You sort of woken up at 2 o'clock in the morning worrying about it. You know, you've helped people come along, you've helped build a business together, you've done something that you're quite
You've
proud
turned
of.
your baby into money.
You have, and that's not necessarily like something that you're that proud of sometimes, perhaps, because that's what you've done. But equally, I think you have to do the right motivation. Never ever forget why you're doing it. I think that's the important thing. And when we went through our transaction recently, that was a conversation we were having quite a bit.
Yeah.
You know, why are we doing this? And you know, what's the outcome for us as a business and all the people within it? And well, I mean, what a place to be. When I first started working in practice at Blackstone Franks, which some of you may know me from, certainly when I met both these gents once upon a time, that was a tiny little office across the road from a hardware repair store, wasn't it? A washing machine repair
Very
stores.
salubrious.
It was salubrious place. Now look where we are. And a lot of that's to do with the transactions that took us and got us here. But never losing sight of what we're trying to achieve with the people we're trying to achieve it with. But it is emotional. There are some bits on the journey, Brendan.
It's really good misaligned shareholders as well. You know, see, some shareholders who would like to sell, some who are very happy with what we're doing, and some who will never sell.
Yeah.
You know, it's trying to. That's where structure becomes so important.
Yeah.
You know, especially we look after a number of families, very large families all over the world, and depends again what structure they're in, what arrangement they're in. Very often you get family members who are quite happy getting the dividend or getting the getting the income off the business, and it's some who are very keen to sell.
Yeah.
And it's trying to align all your shareholders.
And then suddenly you get all kind of the board control, the number of director seats was odd or even, whether it was the tag along, the drag along, like what wasn't buried in the articles, you know. But I think people always think about that, sort of, with enough time to address it.
I've never seen a business that's worth over 50 million where you've got exact shareholder alignment.
Okay,
There's
how do you navigate that then, or herd the different
Again,
parties with different?
Well, very often it comes down to advisors. You know,
Yeah.
what advice are they getting? You're trying to steer them to the right advisors. Again, it comes down to structure. Again, Tom keeps ramming it home. It's so important.
Yeah.
Is it a corporate structure? Is it a private structure? You know, what kind of arrangement are they in? What's the succession planning look like? It's all fundamental as to what happens.
Okay.
I deal with us.
But I mean, for PE-backed businesses, that's where you have drag and tag, right?
Yeah.
Yeah.
You know, at the end of the day, the PE, private equity, venture capital is in the business of, again, turning businesses into money. And they've got to be able to do that. And sometimes, sometimes not everybody wants to do it. But if PE-backed business, if that PE, that lead investor wants to sell, they will sell.
I actually think it's a good sort of, and well, one of the things I think about is, particularly for Gravita, is I feel like we're sort of a Netflix drama. So just bear with me for a second.
Great.
But
What episode are you at?
Well, exactly, that's it. So I think
It's a live stream, guys.
we're in series 1.
Okay.
You know, in terms of this is series 1 with the cast in series 1. We're probably about episode 3. Through our multiple episodes. But I think we're like the Crown, so it kind of lives on forever. And I think it's really important to have the sense that the business itself has a life of its own and a longevity of its own. Regardless of the shareholder. And I think you often see it in sort of. Actually, whether the business obviously is the shareholder quite often, or often is very tightly held. But I think as it gets more structured, you get a better, cleaner separation, perhaps, between the interests.
The business we were in, we had 3 shareholders who had nothing to do with the business whatsoever. They'd helped me set up 12 years ago, and were pretty inactive, and were becoming a problem when we were actually trying to capital raise for future deals. So we made the decision to buy them out, and that was actually funded by the next generation coming through. So we've incentivised the next generation coming through to replace those outgoing shareholders, and that's been a really good, it's the best thing we've ever done.
I think it's really easy to forget though, isn't it? That sort of my very first business I started when I was 21. It was initially a friend and I. We had 50-50 holdings, and then we raised a sort of very small angel round initially, and at that time someone said to me, you just appointed a kingmaker, and we said, what do you mean? So well, you two are even. And you just split your shareholding capital, and even if they had 1% or 10%, didn't make any difference. You've actually handed over voting control if you two get into a dispute to that other person. And we hadn't really thought about it at all. And there was, took a bit of time to actually talk it through and put the controls in place to think actually that wasn't what we were trying to achieve from that structure. So let's sort it out. But I think that kind of real, so many unintended consequences, isn't there, in the setup. Okay, I'm going to ask one more question, then I'm going to throw it open to anybody here with any. But first main question, last question. Should you sell your business before the next change of government?
Let me take it from a tax perspective. Every single budget since I started in tax and understood what it was, these are 2 different times. I've been asked the question, will capital gains tax go up? And every single year I have said no. I am not as confident this time around. I think if we do have a change in government, it is possible that might change. I also think that they might start to, they're certainly going to get rid of carry if Labour come in, so carry interest for private equity, that is almost certainly done. That will turn into income, which a lot of people think it is anyway. So I think there is from a tax perspective, there is a driver to try and do transactions now.
Probably left it a bit late.
Probably have to wait a bit later, but it's perfectly possible that a change in government will bring that in. Now, it may not, no change might happen until like the following April, of course, but so there is a bit of time left. So yes, I'll say that. But also, if it's not property based, just leave. You know, I mean, that's the easiest way to pay less tax in the UK. Don't live it. Go live somewhere else. That's definitely the easiest way of doing it. So, yeah.
You may have missed a few emotional family bits in there.
Yeah, I mean, yeah.
But from a tax perspective.
From a tax perspective, you can get in your family. It's okay. It's fine.
I'm probably going to defer to Tom on this point, but I think if you're not in Dom, I can see definitely people are selling a business now or soon.
Oh, definitely. Yeah.
You know, so I think there probably will be a raft of sales before. Again, depends what we actually end up with, but there could be a lot of interest before next April. If you're still UK res Dom, I don't see the merit in selling. I still think there'll be opportunity. You know.
Brilliant, thank you. Questions from the floor?
Come.
Yes, right at the back.
I've got a question for Oliver and David. So you talked at the beginning of the discussion a little bit about communication and how important it is basically to communicate that. Do you see differences between the VCs and the PE's approach to communication?
So I've dealt with both. VCs more recently. I mean, all the best VCs that I've ever seen have been former owners who've had a great record in actually building and selling businesses and then have gone on to invest themselves. They're the best ones. I mean, I've got our two lead investors in my business are both basically former operators that have sold businesses and have now got their own funds, and their insight and their approach is very good because it's not purely quantitative. They understand the challenges of business and they get what we're trying to do because they've done it themselves. I think obviously a lot of PE people are very much they are bankers, accountants, lawyers. They're very quantitative, business schooly, if you know what I mean. There's a lot of theory and kind of it's Harvard MBA type stuff. It's a very different approach here to in terms of venture and PE, certainly to the US and elsewhere. So the people that I've dealt with in my career on the investment side, that the best people haven't been those kind of advisory types. They've been operators.
I think venture capital used to be better communicating than private equity. I think private equity will better. So the better private equity houses now are better communicators. So especially the last 4 or 5 years, this cycle of private equity we're seeing, our industry in particular, communication is very clear. So they know exactly what they want from that business in that cycle. Or the better private equity houses, it's very clear. Where I don't think there was that message a few years ago. So I think it's changed. So that's what's my
Specialist funds that are better because they are this is my niche, and they understand what you're trying to do. Yeah, a generic venture capital fund or a generic PE fund, it's generalist, so that the expertise isn't necessarily there. So it's what they say is less meaningful.
I had a couple of comments at the end of my previous business. We had two London VCs, Octopus Ventures and Anthemis, and then raised a round out of the US with a business called VC house called Nike Partners, and the chair was a guy called Bruce Wallace, who's now running Brex in the US, who's West Coast, and I think you could probably draw a line from the time zone of London to the West Coast of the US and put it by risk aversion or risk appetite. Yeah. So I think West Coast was very, hey Caroline, if it's not a yeah, it's a hell yeah. And it was all kind of go, revenue, very kind of focused on top line, grow at all costs. I would say New York was somewhere in the middle. It was kind of very American, very, but wanting to do things, but not as much as the West Coast. And London was quite risk averse, and and so I think they're very different styles. And then I think as you move between the VC, they're very focused on market penetration, growth, your customer, the experience, the product, how that feels. PE very focused on the value creation plan and what's that going to look like. And I think as you're saying, but I think where they can add value hugely is talking about what the main value levers are. And I think as long as the investor side know to stay away from the operator side, I think you get a lot of value from the pure play investor as well. More questions?
Just, I guess on the advisor side, how important, do you think it's doing a transaction? Is it to get the right advisors? And have you seen any examples of where it's really gone wrong because you need to buy or sell up, let's try to kind of cut costs and you've not thought about what they're doing?
Yeah, absolutely. I've seen very bad examples. But there's the old saying, you pay peanuts to get monkeys, and it's absolutely true on transactions. So try to get a good advisor, and if you've had a good experience with an advisor and you like them, you trust them, keep using them. So I've seen other examples of people chopping and changing. That doesn't tend to work either. So again, it depends what you're buying. Depends how much advice you need, but you've got it. Advice is absolutely imperative. Tax and legal advice is absolutely imperative.
Yeah, I'd agree with that. And if you like someone, stick with them. Yes. Because they know you. They know what kind of matters to you, so they're already got that kind of experience curve with you as a person, or you as a business. So yeah, I would completely echo that.
No, just agree. I mean, it's what I would. It's what I do for a living. Hopefully, people think I'm okay at it. So, but for me, yeah, I agree. But I mean, if you're going to do a transaction, sometimes this is the only time you're ever going to do one. And we're talking about multiple transactions, PE and VCs. But for most sellers, they do it once. So they want to make sure they're looked after, you give them the right experience, and they get the answers that they're looking for. So they need the right advisor.
Yeah.
They must have it. And it's not. And also, I think we talk about advisor on transaction, but like we were saying about when you've sold your business and you're staying in it, or you've bought one, that's really the only start of the cycle for the seller who may be backing away. That's only the start of their next bit too, right? So they need to sort of talk to them about forward. But yeah, we've seen. I mean, Dan and I work together, so we've worked on some interesting cases over the years. And some of those are, when they have not got decent advice on the other side, it'll be very difficult to get the deal done. Yeah. Because they don't necessarily understand what you're trying to do or why you're trying to do it. You're raising questions, and the answers they give to you are just utterly unhelpful. So yeah, that is one.
Coming back to structure again, and I've seen a situation with a business in our industry where they ended up listing on a minor exchange. They had advice that this was the route to go because they were going to end up getting liquidity and they were going to end up growing as a result of going into this exchange. It was the worst thing they could do. They were either better staying private, going private equity, or actually listing on a major exchange. And it ended up decimating the value of the business, and then it had to break it up. So it kind of comes down to advice and structuring advice, fundamentally.
It leaves me great pleasure to say thank you so much for our wonderful panellists. You've been brilliant, and please to come in for a drink.
Thank you.